Good morning, ladies and gentlemen. Well, the spreads are still extremely negative for all equities and positive for the bonds. We are basically bouncing around it if you look in this box between a score of -52 and -63 and -47 and -53. So more or less it's the same situation. The risk dial is not moving very much at all, and we are approaching the very critical 2600, 2625 area, which I'll now explain why it's so critical. Basically no change from last week in terms of risk spreads, all very negative, and saying to avoid the equities. Anything that we're going to see in equities is only going to be a very short-term bounce, and that's about it. So now let's go and have a look at the charts and see what they say much more precisely. In bonds, all the developments are really, all the exciting developments are really in the short end of the curve, and basically the belly of the curve, 2s and 5s. As you can see, we have now come back decidedly in the 5-year yield. The 310 level was decidedly rejected, and we're now way below the 3%. We're around the 288. We have the, if we enlarge this, we have the 200-day moving average now around the 280 level, and the 50-day moving average is still positively sloped, but that won't last very long. So basically any retracement up to 295 to 297 probably will get sold. Wouldn't surprise me if that happened, but really as we go into the month of December, when moves can be quite violent, and as we go into the new year, should we close the year below the 200-day moving average in the 5-year note, that to me is going to be a very important signal. We have a trend line, we have the 0.786 retracement, we have the 200-day moving average. This area here around the 278 level of yield is going to be very important indeed. If we close the year below it, I think the writing is on the wall for next year. Something very nasty is preparing to happen in the markets. But if we look at the 10-year, that is quite different. It's basically been trading in a almost a bear flag. Bull flag. We could easily break higher. It is a completely different picture to the 5-year note. It is, to my mind, much more neutral, and all it's saying is that the yield curve is going to steepen. If we look at the 30-year note and the TLT, it just keeps on not being able to stay above this very important 115.25 area in the TLT. That to me says that this market is very much undecided about what is going to happen, and really from here at some stage you will see a big move. Either we're going to go all the way back up towards 120, or we're going to break down and make new lows. There's not much in it really. It's binary at the moment. If the market goes to a complete risk-off phase, we will see TLT trade, I would have thought, to this kind of level, 121, 122, 123, which is going to be very tough again to break. But from this 115 area, we either have 7-8 points to the upside, or we have 10 plus points to the downside. We are talking about 101 as the ultimate target from that 115 area. So we have either 8-9 points on the upside, or we have something like 14 points on the downside. That is the alternative that faces us. As far as European yields, you can see they've really been doing nothing for the best part of months, really. We are in a range around 0.34 minus 0.34 in the bubble, the 5-year, to basically plus or minus, say, 10 basis points. So that is a 30 basis point trading range, which just keep on bouncing up and down, relative to Italy, as it were. Germany, there's so little issuance, there's so much of the bonds are being bought by the ECB that it's really tough, very tough to fight it. You get sort of quite sharp moves and then nothing, periods of complete retracement. I would avoid trading Germany at all, and you're seeing much the same thing in the bunds. They are basically trading between 25 basis points and 52 basis points. So, 25 basis points range will be very tough, I think, to break this 25 to 27 area. We will probably give it a go. But unless US bonds start falling apart, I think Germany is not going to go below 25 basis points in the 10-year. Right, and on to the equities, and ES is very interesting because it closed right at the lows for the week, below the weekly Bollinger Band, which to me says that at some stage over the course of the next week we will break the 2603 level, just to clear out stops if nothing else, and probably go to this whatever that is, 2550 area, a very sharp clearing of the stops, and then we can probably rally all the way back up to 2725. To me, that is the most likely path, because we are not going to be able to sustain for much more than 1 or 2 weeks moves below the Bollinger Bands, and these counter trend rallies back up towards 2725, all they're going to do is give time for the Bollinger Bands to actually open up. And if we're going to have a sharp move at some stage, which I would have thought it's going to happen next year as opposed to this year, but with the profile that I've just shown you in the bonds, well, you can never be sure. And if we now have a look at the fundamentals, I'll show you what could happen to ES. Okay, well, the Blue Angels, you've seen how beautifully we basically bounced off the 15 times forward earnings multiple, and how we went to the 16 and fell apart, and now we're back down towards the 15. What does that mean? That means the market is undecided about what multiple it should trade at, and should we actually close below the 15 times multiple, we can probably bet our bottom dollar that at some stage over the course of the next month or so, we will trade at the 14 times multiple. That hasn't happened for a very, very long time. It basically hasn't happened since 2013. We haven't really traded much below the 15 times multiple, or certainly closed with any kind of conviction below the 15 times multiple since 2014. That would be a game changer. And really, we have seen all kinds of markets since 2014. We've seen the earnings recessions, we've seen the dips, and now the forward earnings are beginning to flatten out or even go slightly lower, and that is because of Apple basically being repriced and so on. But it's very, very tough to see it breaking below the lows that we made in February and staying there, unless it's going to go to the 14 times multiple. Why would it go to the 14 times multiple? Only if the market was beginning to price in a major development such as a recession sometime next year. I doubt that we have enough data or conviction to do that at the moment. I'm just showing you that that is the danger. There is very little danger to the upside. I think much below 27.25 is unlikely to be seen this year, in 2018, simply because unless some amazing data comes out, but I just can't see it. So I would have thought now anything below the 15 times Blue Angel, you've got to buy. It's, it's the only sensible thing to do, to resell it around the 2700, 2725, maybe even 2740 area if we develop a bit of a Santa rally. But fundamentally, I see absolutely no reason why we should stay below the 15 times Blue Angel with any conviction for any length of time. If we have a look at the daily charts, they are actually more bearish than the weeklies, but that's not a surprise. But we still have this very pronounced negative divergence here in the RSI. So it would not surprise me to see, as I said, a clearing out of all these stops and then a bounce back towards the 200-day moving average. I don't think we will reach it. I don't think it'll be easy to get anywhere near it, but at some stage that would not surprise me. You clear out the stops, you take the market down towards 25, 30, 25, 50. You spike all the Bollinger Bands on the weeklies and on the dailies, and then you try to rally the market into year end. That to me is the most likely path forward for the next few weeks. The one market which is just falling apart and continues to fall apart is NQ. NQ is now way below the levels that it was at the first spike down. It's now 100 points or so lower, and that is what is dragging the S&Ps. You can see even here we have closed decisively below the Bollinger Bands. We are very oversold, but you can see how close we are to the February lows. 62.50. That's 250 points. That's something that NQ can do in an afternoon. So I really would not be surprised to see NQ take out these levels and then rally towards year end to back up towards 6,800 or even 6,900, 7,000, fail there and then have an absolute nightmare next year. Volatility has been one of the best predictors of what the market is going to do, and you can see that volatility was actually much higher in a few days ago than it is now. Now it's around 21. Before it was trading 25. So volatility is also supporting this argument that the move to clear out new low and to clear out the stops below the market in S&Ps and Nasdaq is going to be probably of a short-term nature, come back and then go again. That is what markets do. They clear out stops and then they come back and then they go again. If we have a look at a weekly chart, that is actually even clearer. And you can see how far below the Bollinger Band we closed last week. Volatility is just saying we are probably not that. We'll have these spikes, but we will trade back down, which to me says if there is a clearing out of stops underneath the market, you actually want to buy calls in the S&Ps. Not so much in the Nasdaq, but in the S&Ps for sure. The one market which is being extremely frustrating at the moment is the dollar, because it's not in a clear trend, although it is above the 96.50 very important pivot level, and basically it is in a slightly upsloping channel. It's doing nothing wrong insofar as if you're bullish and you bought them on a breakout and you have downside protection, you're quite happy. But it's just not giving you the impulsion that one should be expecting towards the 99 to par area. Therefore, I'm less bullish less convinced that we'll see the 99 to par area before year end. This is a very, very slow grind, but I still see absolutely no reason to be bearish of dollars. It's a buy the dip market and then resell it when it spikes the daily Bollinger Bands. It doesn't seem to be in strong trend, but it's certainly not a sell it and go away market. I really don't think being short of dollars is going to make anyone a fortune over the course of the next few weeks. This is actually a chart of DAX, and I'm just showing you to give you how little impulsion to the upside, or how little hope there is for this market. You have these are weekly bars, and these are weekly moving averages, long-term moving averages. You can see how they've all rolled over. At some stage they will all cross, and this will be the perfect bear market scenario, as it were. There is just so little retracement to the upside. If we say that this is a shoulder, a head and a shoulder, we should at some stage come back here and retest the neckline before falling apart. But that's in a perfect technical world, which hardly ever happens. But I'm just showing you, just to give you the background for the equities. Europe just cannot rally. With the banks doing what they are in Europe, being as weak as they are, there's absolutely nothing to look forward to in Europe, and any decent sized rally can be sold almost with impunity. But if you look at the Nikkei, the picture is nowhere near as bearish. It's holding very well inside the Bollinger Bands. It is still above the most important moving averages. Can we come down and test them like we did in February? Yes, we could, but the Nikkei still, to me, is an outperforming market relative, certainly to Europe and even to the States. It seems to be holding within the trading area that it has been in for all year, much better than the other markets. So overall, very little change for our biases for next week. 115.25 is still the key area for TLT. That's where the market needs to prove itself. Bunds and Bobble told you 25-30 basis point range, and all because of Italy and the actions of the ECB. Let's see if any developments happen there. I doubt it. 28.61 is now the level in S&P that I don't think we're going to see that this year. It would just be too easy if we did. These are the levels of where we have the times 15 Blue Angels. Can we come down to times 14? It's possible, but I would still, as a gambling man, as a betting man, playing the odds, it's unlikely. Simply because we haven't seen that since, 2013. And it would really be a shocker for the market if that happened, because that would really be saying recession next year. And I don't think we're quite there. So that would take it down to 24.70-ish, but I just don't see the likelihood of that happening. NQ, still avoid it. Valuations are still very high. NQ could be dragging SPX down, but we should be seeing rotation out of NQ into other sectors. So I still think that this move to 24.70-ish is unlikely. VX, I showed you what I think. Only sort of repeated closes of above 21 show you that there is any immediate danger. It's not the case, and even then 24 to 25 is going to catch it before it comes back down. So that is your trading range. We're much better buyers around the sort of 17-16 area than we are sellers at 24. But we still think we're unlikely to break out of that range for the time being. European equities, just cover them, but if we ever see 11,800, oh, what a godsend. Unlikely. DX 96.50, but it's a very, very, very slow grind up. But we just don't think it's going to fall apart. We just don't see any reason for the dollar to fall apart. and still stay with quality. Always stay with quality in terms of equities, things which have good earnings. It's going to be, this is a period where people are more worried about getting their money back than a return on their money. So stay with quality, as much, as the better quality stocks are going to outperform the less quality stocks. Thank you very much indeed. Hope you had a nice holiday, and tweet you on Monday.